The Jaws of TLT. What do we mean by that? We could equally say the Jaws of Fang. Why do we say that? Because the Jaws, i.e. the divergence that is currently occurring in opposite directions since Silicon Valley National Bank failed, are near historic or at historic divergences from each other, being TLT, 20-year Treasury bond ETF, implying yields have gone down, or up rather, and that market has gone down. There has been a sell-off in yields. And the QQQs has rallied on some other sort of expectation or some other sort of reality. Of course, there are positive earnings surprises, but we can't ignore the fact that these two assets are very well correlated. Very well correlated. And even today, we're seeing a surprise move in stocks that is not necessarily based on earnings, that is not catalyzed by earnings. Not a move yesterday that was catalyzed by earnings, an even bigger move yesterday than we saw today, but a move that was catalyzed by a cooler than expected CPI report. And we saw that CPI report lead to a rally in bonds for a very brief moment. That singular piece of data seemed to have a catalytic effect on the market. But as that data was digested and people thought through and connected more than one dot together rather than just focusing on one simple dot, the bond market turned around, and quite viciously. The 10-year hitting new highs for the month. That is quite extreme because only in the last few weeks we've talked about a pause. And it's been very well expected that tomorrow we're going to get a pause. And I'm not fighting that notion. So why is the 10-year at a new month-to-date high? That's extreme. We're approaching new potential decade highs for the 10-year. We're really not that far off. And I think this is, when you look at the data we got, yes, gasoline prices fell a good amount, but we know the Fed doesn't consider that. When we look at core inflation, yet again, remaining sticky. I mean, it's not like the hawks have been wrong here. It's not like the people who were expecting a lot from the Fed have been wrong here. If anything, I think the people who have been wrong are the people pushing up the Qs since SVB. It seems like that move was a lot to do with Fed pause, the idea of rates possibly having peaked and, a dovish Fed. Well, that you're talking about derivatives of a market which is saying something very different. TLT is saying something very different. And stocks want to just go right back to normal, right back to where we were. But we're not right back to where we were. We're in a very different environment. We have declining consumer spending. We have declining consumer savings. We have declining credit. The economy, while maybe in the past has been good, is not looking so well positioned going forward. And I get it. People always wanted to say when inflation was running hot and the Fed was hiking that they were using backwards looking data. Well, why are they not talking about how the economy is now using backwards looking data? Why are they refusing to accept the fact that the last time interest rates were at these levels, we saw the great financial crisis? The time before that, when the Fed was hiking, and we saw interest rates at these levels, the dot-com bubble burst. There's not a really good modern track record for interest rates at these levels and stocks at all-time highs, particularly when the previous all-time highs occurred not that long ago in an incredibly speculative market where people were doubting the very existence of the US dollar, by far historic money printing, the lowest interest rates we've ever seen, and money literally been being sent out in checks to American citizens. I mean, that is a combination of things that has never happened, and the Fed says never will happen again. So why, with earnings actually declining since then, at the very least, the growth rates we experienced then and were pricing then, no longer continuing in a very clear fashion, so why are we going back to those prices? It's beyond me, especially when we've shredded money. Some meat, like a percent of total money supply, has already been shredded. And even if the Fed stops, they're going to continue this for some time, like years. They're going to keep shredding the money. That's what they're going to do, because the people who got the richest were not the people who saw declining real wages. It was the rich. So I think this is just what I think. I'm looking at everything, and I get the economy has been more resilient, but everything else is not so good. It just isn't. I can't really find anything that's good. I get it. AI might expand profit margins, but that's not necessarily what Microsoft is saying off the bat. And I've yet to see that actually occur in practice. Microsoft apparently yesterday is saying this is going to be a very expensive endeavor for them. This is not going to be some walk in the park, instant profit type situation that people seem to expect to be the case. I mean, NVIDIA, why are they earning more money or making more money right now? Because people are spending more money. So maybe there will be some positive long-term thing. It probably will be, but 30 times earnings in an environment where interest rates, you can essentially make that same return with no risk buying a 10-year. You can actually make more. I can probably make more buying a 10-year. It just doesn't make any sense. The whole thing just doesn't make any sense. And that's what we're going to see. That's what we're seeing in real estate. The White House is saying today the housing market is cooling. Today you have the 40% unprofitable IWM being the top index. You have the KRE, a very large part of the IWM, being incredibly strong, up 2%. You have KRE's regional banks. But yesterday you have Goldman Sachs CEO saying they're taking hits in real estate. So you want to own that junk? I tried it for a day. I immediately just said, I'm not dealing with this risk. And I sold it at a slight loss. And I can sleep easier at night because of that. So I think this is late stage rally. I think it's really becoming disconnected from the fundamentals. I hear the economic strength, but it all makes sense. And it's really not like the economy is growing for earnings. Earnings are actually declining. So I expect that trend to be just in the early stages. We know that the Fed is pausing because they think lagged effects are occurring. All of them are talking about lower growth. They're comfortable with the recession, and that's not priced in at all. With S&P 500 multiples well above historical averages, or slightly above historical averages. You have Apple at near record premiums, at least in recent history, to the S&P 500. I find it highly questionable. So I wouldn't be looking at, end of year 2021 as any sort of fair comp. There are periods of time when stocks decline for 5 and 10 years. And we were just in the most extreme bull market ever. Because think about it, the economy literally shut down and we had one of the most vicious rallies of all time. Think about that. And the forces that led to that are being completely reversed and removed and actually being pushed in the opposite direction. So I just advise exercising a little bit of caution. We'll see what happens. Tomorrow's another big day. That's today's video. Until next time, peace out.